Hey! Have you ever wondered why the market always seems to go against you right before it moves in the direction you expected? Like, you set your stop loss, the price hits it, and then, boom, it goes exactly where you thought it would go. Frustrating, right? Well, Dudu is here to tell you that is not a coincidence. Today, Dudu teaches you everything about liquidity sweeps and trading. By the end of this video, you'll know exactly what a liquidity sweep is, why big players use them, and how you can actually use them to trade smarter. Let's go. Okay, so imagine you're at a candy store. There's a big jar of honey sitting on the shelf, and Dudu wants all of it. But the problem is, Dudu needs someone to sell that honey to me, right? So what does Dudu do? Dudu shakes the shelf a little bit, just enough to make everyone panic and drop their honey. And then Dudu swoops in and grabs it all at a great price. That's basically what a liquidity sweep is in trading. Big players. We're talking big banks, hedge funds, the really powerful people in the market. They need a ton of buyers or sellers to fill their huge orders. So where do they find them? They find them hiding around stop losses. See, when regular traders place stop losses, they're basically saying, if price goes here, I'm out. And when thousands of traders all put their stop losses in the same area, just below a support level or just above a resistance level, that creates a big pool of orders. Traders call this a liquidity pool. The big players know it's there, so they push the price into that zone, trigger all those stop losses, grab all that liquidity, all those orders, and then reverse the price in the other direction. Honey, that's how it works. The little traders get stopped out, the big players get their fill, and the real move begins. Easy peasy. Well, once you know the trick. Alright, let's look at a real example using gold. Xayuzde. Because Dudu loves gold almost as much as Dudu loves honey. So imagine gold has been going up, and there's a really obvious support level sitting at, let's say, $2,300. Lots of traders see it, lots of traders buy there, and here's the important part. Lots of traders place their stop losses just below it, around $2,290. That cluster of stop losses, that's the liquidity pool. Now, the big players want to buy a massive amount of gold. They need sellers to buy from. So what happens? Price suddenly dips below 2,300 down to 2,288 or so, triggering all those stop losses. All those traders get kicked out of their trades. But then, almost immediately, price snaps back up above $2,300 and starts a strong bullish move. The people who got stopped out are watching in disbelief. But if you knew about liquidity sweeps, you wouldn't be in that trade yet. You'd be watching, waiting for that sweep to happen, and entering right as price reclaims $2,300, catching the real move from the beginning. Bear with me on this one. It takes practice, but it is so worth it. So how do you actually use liquidity sweeps in your trading? First, identify key levels. Look for obvious support and resistance zones that a lot of traders are watching. If it's super obvious on the chart, there's probably a liquidity pool sitting right there. Second, watch for a sharp, quick price spike through that level. This move will look aggressive and scary, like the trend is breaking. Don't panic, this is the sweep happening. Third, wait for confirmation that price comes back through the level and closes on the other side. That reclaim candle is your signal. Fourth, enter your trade in the direction of the reclaim. Place your stop loss below the sweep low or above the sweep high, and target the next key level. That's your trade, simple, clean, and you're trading with the big players instead of getting eaten by them. Dudu got you with some pro tips now. Tip 1. The best liquidity sweeps happen at the London or New York market open. That's when the big players are most active, so watch those times closely. Tip 2. If the sweep happens on a higher time frame, like the 4-hour or daily chart, it's way more powerful. The bigger the time frame, the bigger the move after. Tip 3. Don't chase the sweep while it's happening. Wait, patience is Dudu's secret weapon. The entry comes after the reclaim, not during the chaos. So, to wrap it up, a liquidity sweep is when big players push price into a zone of stop losses to grab orders, and then reverse hard in the other direction. And now, you know how to spot it and trade it like a pro. If this video helped you, smash that subscribe button and join the Dudu Trades family. New trading videos every week, made just for you. See you in the next one.